What's up, guys? It's Blake from You've Got Tech. Here coming at you guys on my lunch break to discuss Coinbase and Binance being sued by the SEC for acting as unregistered brokerages, clearing agencies, and exchanges. Now, for those paying attention, it's no surprise. We know that Gary Gensler, the chair of the SEC, has been looking to slap them with the long arm of the law. There actually was a Wells notice that was issued to Coinbase back in March of this year. And so if you were on the lookout, this shouldn't have come as much of a surprise. But if you were living under a rock, maybe you have too much exposure to Coinbase. Maybe if you're outside of the US, you have a lot of exposure to Binance. I know there was $780 million of withdrawals instantly in a 24-hour trading period. Obviously, we have volatility in the market all the time. Crypto traders are used to it. Almost $1 billion of withdrawals in a day. It's a bit of a bank run to me. But what can you do from this point forward? Aside from running scared or hiding your money under your mattress? Well, I think the answer is either keep doing what's been working for you and stick to your strategy, stick to your guns, or you could do a little bit of a hedge. Now, in my book, what I've done is transfer the majority of my funds. I do think that Fidelity is a bit more of an old school brokerage, kind of out of the purview of the SEC. Obviously, they're not offering as many tokens. They're not offering as many non-security assets that could be questionable whether they're passing the Howey test or not, which is a whole other topic for another discussion. Whether there's a vagueness to the regulation or the lack thereof on whether or not certain assets could be considered securities, commodities, or property. And we know which side of the fence we are on. There's really no room for debate, at least for Bitcoin, it's property. But that doesn't mean that your exchange couldn't be a risk. So be careful out there. Nobody's going to pivot and adjust their strategy for you. But believe in the assets you're convicted in and secure them and make sure that it's your keys, not your crypto. So if you are going to have money on the exchange, obviously you have to have some to trade with. Make sure that your exchange is not currently under attack, would be my advice. I actually think we should take it one step further with Coinbase. We know from the Kraken settlement, another exchange, mostly outside of the US, but some US users from many years ago, Kraken settled for their staking assets, right? Their staking product had been considered a security, and Kraken settled. You pay the fine, which in Kraken's case was $30 million back in February of this year, and you make it so that Gary Gensler doesn't get a solid, unbelievable gavel of a win for the SEC. So kind of both sides lose and nothing changes in that regard. Nobody gets an idea of what's going to come to go forward. The SEC doesn't get to make an example out of a company. And unfortunately, we continue trudging through the mud. Now, Coinbase has their own staking product. So they're in the same boat. They've issued a product that has 5 tokens that stack on top of each other. And that's being considered a security, according to Gary Gensler. So, of course, we have a lack of regulation. We have a lack of a set of standardized rules and ways to behave as an exchange or as a brokerage or as a clearinghouse. So, of course, the legal officers at Coinbase are claiming the way to move forward is not to litigate, it's to create a roadmap. But they're going to have to settle out of court as well. Otherwise, they're not going to have any liquidity in their stock. And they won't be able to raise money to grow their business and to recover from this mess. That's the whole reason why we believe in crypto in the first place, is to get away from the banks having the control and the centralization of your money. So make it your keys, make it your crypto, get it off the exchange, keep whatever you have to on the exchange with a brokerage that you trust. End of story. Now, for these crypto staking tools, they're actually in what's called a liquidity pool. But if there's a run on the exchange or the institution where you have your product staked, Terra Luna, then how much liquidity do you have in your pool? Now, they work with crypto pairs. You could pair Ethereum with Bitcoin, or wrapped Bitcoin with wrapped Ethereum, or any token really. And so, of course, in that, right, it's a topic for another video. But what it certainly leaves room for is manipulation and uncertainty and doubt. And it allows the SEC to jump, to pounce. There is one nugget in all of this that's pretty interesting, and that is that the SEC is actually also coming after specific crypto tokens. So what does that mean for the initial creators of the token, or the tokens with their initial coin offering? And the tokens that they mentioned are Solana, Polygon, right, Matic, Algorand, Internet Computer Protocol, Filecoin, and several others. In the past, they came after Justin Tron, the creator of Tron Coin, right? But if they're going after individual tokens and calling those securities, where does it end? There's 20-something thousand tokens, and that was before Bitcoin blockchain had their own, like, BTC20 versus ERC20 tokens. So it's probably more like 30-something thousand tokens now. So they got their work cut out for them. So that's this Tuesday News Day. This is Blake from You've Got Tech. Maybe we'll see you tomorrow. Who knows?